Dear students, I have come with a new module, Sale of Goods Act 1930. This is a new chapter and this is the third chapter. So we will see what are the provisions regarding Sale of Goods Act 1930. Now, let us see the introduction. This act came into force on July 1st, 1930. So earlier, why there was no Sale of Goods Act? So you have to remember, this act was under all the conditions regarding sale of goods were also covered under Indian Contract Act 1872. But now you know that the way we shop, the way we buy things, way we provide services, way we enjoy services, way we make payments, it's totally different. It's fully online and anywhere in the globe, if one product is available, we can buy that. So here, that there was a need for a special act. So that is what we are going to cover in Sale of Goods Act 1930. Now, what is the definition of sale of goods? As per Section 4 of the Sale of Goods Act 1930, a contract whereby the seller transfers or agrees to transfer the property in goods to the buyer for a price. So some features of the Sale of Goods Act, one thing is seller and buyer is there, two parties are there. Then the seller is transferring the ownership to the buyer. Then it's for a price. So if we can list the features of Sale of Goods Act that I will tell you now. So essential features of a contract of sale of goods. One is bilateral contract. Two or more than two parties will be there. Definitely buyer and seller will be there. Then seller is transferring ownership to the buyer. That is the second characteristic. Third, some goods are transferred. We are going to see the classification of goods. It can be existing, future goods, contingent goods. We are going to learn in detail in this module itself. Then the next characteristic is the price. So price is nobody will give us anything free. We have to pay for that. So that is the price. Next is it includes sale and agreement to sale. That meaning both cash sales and credit sales. Agreement to sell meaning the contract is not completed. It will complete on a future date. Maybe transferring ownership, maybe the payment. Then next is all essential elements of a valid contract should be included or should be covered in a Sale of Goods Act to make it a valid contract. So these are the essential features of a contract of sale of goods. Now let us see the difference between sale and agreement to sale. So if you see the type of goods, sale is only regarding existing or specific goods. Sale is immediate. So if you go to a supermarket, all whatever is displayed in the shelf, you can pick and pay for it and you can get it. Existing goods or specific goods. You are going for it to your automobile dealer. The brand you are looking for is readily available. So that is the sale. Whereas agreement to sell, future and contingent goods. See, if I want to buy a Rolls-Royce car, it will not be readily available. It is made to order. So that will come as an agreement to sell. We make the payment, then they will start making according to our choice. So that is it for future and contingent goods. Next is nature of rights. In the case of sale, buyer gets the rights against the whole world because in sale, ownership is transferred from seller to buyer. Then after sale, buyer is the owner. He is getting the ownership against the whole world. In agreement to sell, buyer gets rights against a particular person only. If you have made payment for a consumer durable, part payment, then the buyer gets the rights only against the seller, not against the whole world. So that is the nature of rights regarding sale and agreement to sell. Continuing with that, consequences for breach by buyer. If buyer has not made the payment. In the case of sale, seller can sue for price. So that meaning seller has parted with the goods, but the buyer has not made the payment. So seller has the right to sue for the price. Whereas in the case of agreement to sell, seller can sue for damages and not for the price. They started making a Rolls-Royce car or Mercedes-Benz car according to our choice, according to the order we gave. So that will be a loss for the seller. So he can sue for damages. Whereas in the case of sale, you have to remember the seller can sue for price. Next is right to resell. In the case of sale, seller has no right even if goods are in his possession. Imagine buyer made all the payment, but still the item we are leaving with the seller itself. Even if the item is with the seller has no right for resale because in sale, ownership is already transferred to the buyer. Whereas in the case of agreement to sell, seller has the right because the buyer has not fulfilled his promise. He may not have made the payment. He may not have accepted the item. So seller has the right to resell the item. Continuing with that, insolvency of seller. In the case of sale, buyer can recover goods from the official receiver. Now, who is the official receiver? We have to remember, in the case of insolvency or bankruptcy filed by somebody, so the court will appoint an official liquidator. So official liquidator is or the official receiver. So he will make a list of all assets and all liabilities, and they will sell all the assets and all liabilities. They want to clear the liabilities. Sometimes we have to collect 100 rupees from the person. We may not get that because the insolvency meaning they're claiming that they don't have the full assets to clear their liabilities. So in case of insolvency of seller, buyer can recover goods from the official receiver because buyer has made the payment for that. He need not wait for that official receiver to release the amount. He has paid that. He can show that whatever the payment made, and the collected item is in the custody of the official receiver. So the buyer can collect it from the official receiver because he has already made for that. Whereas in the case of agreement to sell, buyer can claim only a rateable dividend and not goods. See, in the case of agreement to sell, we have to remember that official receiver will start the process, all the assets, selling the assets and clearing the liabilities. So if you, as I told you, if you owe 100 rupees from the person, seller, it may not be possible to collect 100. So sometimes they will decide a rateable dividend. It may be 40 paise per 1 rupee, 50 paise per 1 rupee. So whatever the rateable dividend calculated, we will get it. The buyer will get it. Next is insolvency of buyer. This is the last point for this distinction. In the case of sale, seller can claim only a rateable dividend. See, this is insolvency of buyer. Insolvency of seller is different, buyer is different. So seller has to return the item to the official receiver if the buyer has not paid for the price. Because when buyer is filing for insolvency, all the assets should go to the official receiver. Whereas in the case of agreement to sell, seller can retain the item as he is the owner. So seller need not part with the item in the case of insolvency of buyer. So these are the differences between sale and agreement to sell. Now we have to see the classification of goods. I have mentioned that I'm going to explain 3 types of goods, that is existing goods, future goods and contingent goods. Now, types of existing goods. Specific goods, ascertained goods and unascertained goods. Now let us see what are the specific goods. Specific goods, you have to see that when we go to specific goods are the existing goods which are existing at the time of sale. Goods are in seller's ownership and possession at the time of entering into contract. The best example is the supermarket, the regular provision we will buy, fruits or vegetables or fish or meat or anything. You go to the shop, it's readily available. So you can buy that by paying the amount. That is specific or existing goods. You don't have to wait. You can enter into a contract of sale. Now, specific goods as per section 2, subsection 14 of the Sale of Goods Act 1930, goods identified and agreed upon at the time of sale. So here, the definition for specific good is given by Sale of Goods Act. Goods identified and agreed upon at the time of sale. So examples, car identified, building, apartment for sale, identified and negotiated between buyer and seller. Now unascertained goods. See, for example, in an apartment, some 1,000, 2,000 apartments are there. So that meaning it's unascertained. When you go there, it's unascertained. Whichever you are selecting, it can be one from that 2,000. So goods which are not identified at the time of sale. So imagine a builder is announcing that I am going to do the Bhumi Puja. I am going to construct 2,000 apartments. So here the point is that anything whichever they will construct at the time of entering into sale, the buyer is making the down payment. He is entering into a contract of sale. When it will be completed, you will get an apartment, but it is not identified. So goods which are defined by description. Builder will give the description, how your flat will look like. He will show you the model flat. A contract to buy, or another example, a contract to buy 10 cars from a car dealer who has 20 cars. Now, the last point is ascertained goods. Ascertained goods in the existing classification, goods which are identified subsequent to the formation of the contract. After entering into contract with the car dealer, in the previous example, 10 cars of your choice you have identified, then it will become ascertained goods. Now we'll come to the future goods. What is future goods? Because this is the second classification of goods. As per section 2, subsection 6 of the Sale of Goods Act, goods to be manufactured, produced or acquired by the seller after making if the contract are called future goods. So example, future crop for paddy, mangoes, vegetables, any agricultural produce based on the cultivation, they will enter into contract. So here you have to remember that sale is not possible, only an agreement to sale is only possible because it's based on a future event, future goods. That is why it's called future goods. Now the last point from this module, that is contingent goods. As per section 6, subsection 2 of the Sale of Goods Act 1930, goods, the acquisition of which by the seller depends upon an uncertain contingency are called contingent goods. So this is the definition. So now we have lot of arguments going on about the import of rice. Central government has certain restrictions. So that meaning an agreement to sell only it is possible here. So government is changing the rules and regulations. Last week they have given the permission to import of rice to Singapore alone. They have allowed that, they have given the permission. So if you have entered into any other country for import of rice, then sale it's not possible, agreement to sell only possible, and there that it will depend on the central government policy. That is why it's called the contingent goods. So in this module I have given the explanation about the sale of goods, essential conditions, type of goods, and distinction between sale and agreement to sell. Happy learning. Thank you.